Hi friends, today's second Business Standard editorial is titled A Broken Model. It is basically a simple editorial. It tells about one thing, China's economic troubles as of now. It is stating that China's export-oriented economy, on the back of which it rose to be a global superpower, has finally run out of its steam. It is not a sustainable model anymore, and the policymakers should shift their focus towards domestic consumption to maintain their economy, but they are not doing it. Instead, their current focus is to be technologically self-sufficient on the back of the current geopolitical situation. This is the gist of today's editorial. It's talking about the China's crisis, economic crisis, and as we know, China is facing various geopolitical issues like factories relocating from China, Mr. Trump, US President, issuing tariffs on Chinese exports, etc. and etc. So there is nothing more to be told on the editorial as such, but in order to understand this story, we need to get an idea of how China works, some financial terms, etc. So let's get into that. How do we know that China is having problems? We know that China is a very opaque country. We cannot get to know what is happening in the country economically or financially as easy as other countries. So how did we find out? It is through the various things that government do. For example, since 1991, for the first time, China has set a low growth target for the economy at 4.5 to 5%. Since 2023, the growth target was a minimum of 5%. There is something known as draft government work report, which is basically a report that tells how China's economy performed in the previous year and lays out the guidelines for the next, that is the current running year. China, through that report, has in a way admitted that it has reached its limit to stimulate the growth through export-oriented growth. Its president, Xi Jinping, has openly given directive to local governments to cut on wasteful projects. China has a high production capacity, so much that it leads to an oversupply of goods. This was built on the back of cheap credit and undervalued exchange rate, but since for the first time since 1989, the fixed asset investment that was used to build this high production has dropped in 2025. Now, China debt issues. China is highly indebted. Its non-financial debt to GDP ratio is over 300, and the government debt to GDP is touching 90%. For reference, India's non-financial debt to GDP is at 170 to 180, and the union government debt to GDP is 56%. Combined with states, it is 82%. What is non-financial debt to GDP? Let's first understand that it is the debt of household plus non-financial corporation plus government divided by GDP expressed as a percentage. In China's case, this particular ratio consists of high corporate debt, often state-owned enterprises, and household mortgages fueled by the infrastructure and property booms. The financial sector debt, why we are taking non-financial sector debt to GDP, because in financial sector debt consists of interbank loans and people taking leverage to play in the stock market like derivatives. So it is avoided, the financial sector is avoided to get a tangible idea of the actual economy, real economy, such as the producing and exchanging of goods and services like manufacturing, construction, agriculture, retail, and labor. Now, government debt to GDP, straightforward, it is a debt of central and local governments divided by GDP expressed as a percentage. The highlight is that it excludes off-balance sheet borrowings of the local government and others. If that too was included, means total debt would have been much higher. The government debt to GDP is already accounted in the non-financial debt to GDP. Now, why did China take up so much debt? Because China ran an investment and credit fuel growth model for decades, financed heavily by household spendings and local government borrowing, especially into the property and infrastructure. They are the non-financial sector. The interest rate on deposits were kept low, so the banks would get easy money to lend. Also invested in real estate to get better returns than bank deposits and they did this by taking loans. So real estate itself was growing on the on the back of huge loans that it took. We saw how real estate debt crisis unraveled in China in 2021, and China's local government, one of the biggest culprit of the debt issue, took off-balance sheet borrowings, something that would not add up in their total debt to build infrastructure. Again, through subsidies using government debt, China was keeping its prices artificially low to promote exports. Add to this, during pandemic, China increased its bond issuance both at the central and local government level to finance stimulus spending. Overall, if you see, it's just a huge pile of debt walking around. When such debt increases, government has to set aside a higher amount for making interest and principal payment, and productive spending like infrastructure, education, R&D will be redirected. The government is finally admitting that it has run out of the money to run this unsustainable cycle of debt-led growth. Now, the GDP has different components, including household consumption plus business investment plus government spending plus net export. So when net exports and business investment is not performing, then the ideal next step is to increase household spending, which currently the government is focusing to do, but no policies are being made. Now, the solution: make policies to improve domestic demand through household spending. It's raising wages, supporting employment, shifting income towards lower and middle income groups, reducing taxes, better labor protection, reducing reliance on infrastructural subsidies, and redirecting such government resources towards household transfers, consumption supporting programs, stabilizing housing and labor market, etc. Many things can be done to help China get out of this issue. Now, I will end this discussion by giving you a brief. This is not the actual way, but just to give you an idea. China, how does China keeps its currency undervalued? Chinese exporters earn foreign currency when they sell goods abroad. Central bank buy these foreign currencies, say dollars, from them and issue yuan to them. Now the dollar, for by buying dollar from the people, the demand for dollar has increased, and by giving yuan to the people, the supply of yuan has increased. So yuan is kept artificially low. The price of yuan is kept artificially low, and because of this constant buying of dollar, China has high foreign exchange reserve. The central bank issue bonds to absorb the excess yuan from the economy, which they gave by taking up dollars, and this is to prevent inflation. Then this yuan is again used to buy the US treasuries or issue loans to the non-infrastructure sector. Additionally, China has strict control on the flow of money into and out of the country. So to add up all this together, and China keeps its currency the way it wants it to be. Thank you.